Hello everyone. So what we are going to do today is that we are going to focus on a very important reading in equity material, which is going to be valuation of equity securities, which is a very important reading for CFA Level 1. So what we are going to talk about in today's reading is that we are going to evaluate a range of valuation techniques and methods available to understand how we value equity securities in all of those approaches. And end of the day, if you are an investor or a portfolio manager, the most important thing that you need to remember is that you need to understand if a stock is undervalued or overvalued. So in order to decide whether a stock is undervalued or overvalued, we need to use a wide range of valuation techniques to decide what is the intrinsic value of a stock. So the challenge for any analyst working in the sell side or buy side firms is to understand what is the intrinsic value of a stock, because end of the day, you're going to look at the intrinsic value of a stock, compare that with the market price of the stock to decide if a stock is undervalued or overvalued. So potentially, if your stock is undervalued, you think the stock is cheaper, so that you issue a buy recommendation on the stock. On the other hand, if you think the stock is overvalued, meaning the intrinsic value is lower than the market price, the stock is expensive. So which means that you issue a sell recommendation on these stocks. I'm actually talking about the life of a sell side equity analyst. So this is the challenge for us, to master the material on a wide range of valuation techniques available. We start the introduction to basic valuation techniques in level 1, and then we move on to level 2, where the equity valuation, they share a higher weightage in level 2. We are going to dive more deep into more complex valuation techniques in level 1. So in level 2, in level 1, we just introduce basic valuation techniques, which is very important from an exam context. So let's get into the slides to start talking about. Here we are talking about this reading, equity valuation, concepts and basic tools. As we discussed before, what we are going to do here is that we're always going to compare the market price of a stock with the estimated value. And this estimated value, remember, is the value that we derive using the valuation method that the analyst is using, right? So we are trying to arrive at the intrinsic value, and that is what is called estimated value here. So if the estimated value is more than the market price, you think it's a cheap bet for you. The stock is undervalued, so it's like kind of a good investment opportunity. You buy the stock now, because end of the day, remember, the reason why you say it is a buy, because you think at some point in time, usually over the next 12 months or so, you expect the stock price to reach back to its intrinsic value. For example, if you think the stock is trading at $10 now, but the intrinsic value is $12, so you have a 20% upside. So you expect the stock price to go towards the intrinsic value over the next 12 months. So you think the stock price, you currently buy them at 10 because it's trading at 10, and you expect it to go up to 12. Why do you expect it to go up to 12? Because you think that is the real value of the stock based on whatever the valuation methods that you are using. But if it is overvalued, which would mean the estimated value is lower than the market price, so you short the stock or you sell them because it is expensive. Because what you expect, the stock is trading at, let's say, $15, but you think the intrinsic value is only 10. So meaning that your valuation model suggests to you the value of the stock is just 10. But in the market, it is trading at $15. So what do you expect? You expect the stock prices to go down. You expect the stock prices to go down to $10. So that's what exactly you expect it to happen. So the fundamental notion is that everybody expects the stock prices converge towards it is intrinsic value over a period of time, right? So if you, I mean, you know, one of the critics, you know, you could argue that, you know, the security prices might never reach their intrinsic value, meaning it can continue to be, a stock can continues to be overpriced or a stock can continues to be underpriced. So in such a market, so it is very difficult for you to issue a buy recommendation or a sell recommendation. So that's kind of a difficult situation. You probably, yeah, as some of you have just mentioned, that it could be a market with, you know, an imperfect market where the market is not correctly reflecting all the available information into the share price, right? Again, look at this particular statement. This looks more interesting. Market price is more likely to be correct when a security is followed by many analysts. If a stock is covered by a wide range of analysts, which would mean there is correct information about the stock in the market. So all the analysts research the stock and identify an appropriate intrinsic value for that. So people, investors, portfolio managers, they have enough information to decide whether to buy the stock or not. So in that case, the market price of the stock will be very close to the intrinsic value. But the negative news for investors and portfolio managers is that in this scenario, you know, you can't make money because your stock price and the intrinsic value are the same. So in that case, I mean, you know, shorting the stock or going long on the stock is not going to work, because the stock price is already at intrinsic value. So when do you think investors get excited? Can some of you answer this question? When do you think investors and portfolio managers get excited about stock market investments? You know, they don't want the stock price and the intrinsic value to be the same, because if that is the same, there is no role for the portfolio managers or equity analysts to say whether the stock is buy or not. So when do you think investors are going to get excited? Investors and portfolio managers and equity analysts are going to get excited when the stock price is actually different from the intrinsic value or significantly different from your intrinsic value. So, you know, there is kind of portfolio manager could either go long on the stock if the estimated value is more than the market price. He could buy the stock into the portfolio, or he could sell if he already has a stock in his portfolio if the estimated value is less than the market price. So the stock price is overvalued and it is expected to come down. So that's how you make decisions. So the portfolio manager can sell them if he already has, or he can short the stock if shorting is permitted as part of his investment policy statement. So this is a very important slide, you guys, to understand what's going on. And moving on to the next slide, where we are establishing the foundation for this particular reading, where we are going to talk about what are the various range of valuation methods available to decide whether a stock is overvalued or undervalued. This is exactly what we are trying to identify. We are trying to identify intrinsic value of a stock, what is the real value of a stock, using various valuation methods. There is one called discounted cash flow models, multiplier models, and then the third one is asset-based models. So using these three models, we are going to determine what is the intrinsic value of the stock, step one, and step two, we are going to compare that with the current market price to decide if the stock is overvalued or undervalued. Again, it's always worth going back to this slide. The stock is overvalued when the estimated value or the intrinsic price is less than the market price, because the stock price is expected to fall down. But when market price is less than the intrinsic value, you expect the stock prices to go up, and then you issue a buy recommendation on the stock. So that's how it works. So we are actually going to use discounted cash flow models, multiplier models, asset-based model to determine the intrinsic value. The next question that anybody could ask is that why do we use a range of valuation techniques? Why not we only use multiplier model or asset-based models or discounted cash flow models to determine the intrinsic value, right? So now there are few things that you need to remember. Number one, just relying on one valuation technique might not tell you the real value of a stock. So that is one of the reasons why analysts usually look at a range of valuation methods, right? Because various valuation methods, they've got their own issues. They got their merits and demerits. So it is always better to use them with caution. So that's what it is always recommended, to look at more than just one valuation method to value a stock. That is point number one. Point number two, you also need to know valuation methods that we use to value securities are industry specific, right? If you think about maybe in banking industry, if you're trying to value a banking stock, maybe you look at multiplier approach. Price to book value is a good indication, or you can use residual income approach to value banks. But if you think about, telco industry, we focus on EV to EBITDA, because it's a capital intensive industry. We use EV EBITDA multiple. So for different industries, we use different techniques. Like, for example, consultancy companies or telco companies, we cannot use asset-based models. We cannot use price to book value, because these companies do not have rich tangible assets. So you need to understand these are a range of options available for you to value stocks. You could either use discounted cash flow models, multiplier models, or asset-based model, or a combination of them to arrive at a value for a stock. But keep in mind, valuation techniques, the appropriateness of valuation techniques would also depend on which industry the particular company is operating. So you also need to keep that in mind. Okay, now what is discounted cash flow models? In discounted cash flow models, what we do is we are going to value a stock based on its estimated future cash flows. So we are going to estimate the future cash flows of a company and discount all the cash flows to arrive at the present value, because keep in mind that we are trying to value the stock today. So anything that you do in valuation needs to be brought back to today. And that's why the concept of present value is heavily used in the valuation of equity securities. So discounted cash flow models, we have two types of techniques available here. One is we are going to use dividend discount model, and then we are going to use free cash flow to the firm or free cash flow to the equity models to value stocks. I'll get into details. So this is a cash flow based valuation model. The only thing that you need to remember is that in this approach, value of a stock is nothing but its future cash flows discounted at an appropriate discount rate. We call them cost of equity, because we are trying to value an equity investment. So when you're trying to value an equity investment, the right cost of capital to use is the cost of equity, because from corporate finance study session, you know that when you're assessing a project for a company, we use WACC, weighted average cost of capital, right? If the risk of the project is similar to the risk of the company. But when it comes to equity valuation, keep in mind we use cost of equity, because at the end of the day, what are we trying to value is we are trying to value an equity investment. Hope that makes sense. Moving down into the second method, multiplier approach. This is very popular. Everybody talks about PE, price to book value, EV to EBITDA. We are always going to compare the price of a security, which is the market price, to its earnings, to its book value, to its cash flow, so its sales. So that's multiplier model. Multiplier model, we usually call it a relative valuation model. Why? Because we could always check the valuation multiple like PE, price to book, EV to EBITDA, compare them with an industry average or compare them with a nearest competitor to decide if a stock is overvalued or undervalued. For example, just a rule of thumb is that if a stock is trading at a PE multiple of 10 times, but the industry PE multiple is 15 times, in the absence of any other information, we conclude that the stock is undervalued because it is trading at a lower premium to the industry. The industry average of the price earnings multiple is 15 times, but a company's price to earnings multiple is 10 times, so which means the premium that is paid by the investors to buy the company is 10 times over its earnings, but for the industry it's 15 times, so that way it is undervalued. So this is how we do in multiplier model. It is a relative valuation approach, and we say discounted cash flow models is an absolute valuation technique, because this is going to give you straight away what is the value of a stock, but a multiplier model wouldn't. You need to rely on industry average or nearest competitors multiples to arrive at a value for a stock. You would realize when we start working on them in the slides to come. And then the last one, asset-based valuation methods, where we are going to value a company based on its balance sheet. So we're going to understand, okay, what is the book value of the company, which is total assets minus total liabilities in the balance sheet is going to give you the net worth. So based on the net worth in the books, we are going to compare that with the market price to see how overvalued or undervalued a company is. So that's an asset-based valuation method. Maybe when you are valuing companies for some industries like banking, it makes more sense to look at asset-based valuation. But some industries, as I told you earlier, like consultancy or technology, where companies do not have much assets in the balance sheet, it is always better to look at some other alternative approaches. So asset-based valuation could be a good start, but it has got its own issues. We'll talk about them more in details as we go into the details, right? Now, before getting into the first approach, we are first going to talk about dividend discount model. We are going to focus on discounted cash flow model, and in that we are going to talk about dividend discount model. Before going into dividend discount model, I would like to make sure that you guys are familiar with some of the key things related to dividends, because this model, dividend discount model, means we are trying to value a company based on the dividends the company is going to pay in the future. So in simple terms, if you want to understand dividend discount model, the dividend discount model would mean that the value of the company is nothing but its future dividends until infinity, discounted by the cost of equity, is going to give you the value of the company today. So this is the notion of any cash flow based valuation model. What we are going to do is we are going to value the company as the present value of its future estimated cash flow. So what we are going to do is we are going to forecast the company's dividends until infinity, discount them back, and say this is the value that you should be paying today to buy this stock, and that becomes the intrinsic value. So that is the notion of dividend discount model. So before getting into more detail, I would like to make sure that you guys understand some of the basic terms that we very often use in the dividend valuation model. So you need to understand there are different forms of dividends a company pays. The number one is cash dividend. A cash dividend is something, a dividend paid in cash to the shareholders, right? The companies can pay annual dividends end of the year, or interim dividends. Some companies pay more dividends more than one during a year, so that's called interim dividends, right? Or there are circumstances where companies pay special dividends, like let's say you had an exceptional year with good profits, you want to pay a special dividend. And there are other circumstances a company might want to pay a special dividend, is that if the company sees no investment opportunities outside for them to reinvest the money, then that's again another reason why companies pay special dividends to return the money to the shareholders. Right, then again, remember something I want to say, higher the cash dividends, lower the reinvestment for the company, and lower the cash dividend, more retention and more reinvestment opportunities for the company. So this is something that you need to remember. Moving further down in slide 83, we are actually going to talk about different type of dividends that are available. Number one is stock dividend, number two is stock split, and number three is reverse stock split. So what I'm going to do is I'm going to use an Excel spreadsheet to demonstrate you what each of these would mean. But end of the day, one thing that you need to understand is that whether it is a stock dividend or some people call this bonus shares, right? Whether you are talking about a stock dividend or a bonus share, or whether you are talking about a stock split, or whether you are talking about a reverse stock split, which is opposite of stock split, whatever you do, the value of the company does not change. So you need to understand. So let's explain what these things, and then I go into an Excel sheet and show you how the value doesn't change in all of these scenarios. The first one is stock dividend, payment to shareholders in shares of stock. So you don't pay cash dividends, right? But you actually pay dividends in the form of shares, free shares. So you're going to say 10% stock dividend, meaning if you got 10,000 shares and if the company pays 10% stock dividend, you got 10% times 10,000 shares. So you get additional 1,000 shares, and your number of shares become 10,000 to 11,000. So your number of shares increases from 10,000 to 11,000 because the company announced a 10% stock dividend. But you're not going to get any cash, but your number of shares is actually going to go up. But remember, as I told you, it doesn't mean now you have more number of shares or more value. Your value is not going to change, because when the number of shares increase, what happens to your earnings per share? Your earnings per share is going to get diluted. Your book value per share is going to get diluted. So your value is going to get diluted in proportion to the increase in number of shares. So end of the day, there is nothing happens when there is a stock dividend. Stock split is a company is trying to split its stocks to issue many number of shares as possible in order to increase the liquidity of the stock in the stock market. For example, if a company says that they are going to split the stock 2-for-1. So what does that mean? Proportionate increase in the number of shares outstanding. So your number of shares outstanding is going to increase. So they are actually going to split it for 2-for-1, right? So for every 1 shares, the shares are actually going to split into 2. So that's what the meaning of a stock split. So there are stock splits, they say 1-for-10, 10-for-1, any type of stock splits, depending on how many additional shares the company wants to bring in. So that's what we mean stock splits. And reverse stock splits, this is the opposite of stock splits. What happens in stock splits is that the number of shares increases, but in the reverse stock splits, the number of shares decreases, meaning there are 1,000 shares and company wants to make it to 500. That is reverse stock split. If there is 500 shares, the company wants to make it to 1,000 shares. So that is a stock split. So you understand a stock split and reverse stock splits will do the opposite for number of shares, but at the end of the day, the value of the company does not really change, and I'm going to explain you using an Excel spreadsheet. Let's see how it works. Okay, here you go. So what we're going to talk about is I'm going to show you how a stock split or a reverse stock split should not have any impact on the value of company, right? So that's exactly what we are going to talk about. Are you guys able to see my screen? Hello, are you there? Can you see my screen? All right, fantastic. Okay, so what we're going to do is we are going to talk about the share split, and we are going to talk about bonus share split, and we are going to talk about reverse share split, and we are going to talk about stock dividends. Okay, let's take a look. Now, a company has 100,000 shares in issue. Right, you've got 100,000 shares in issue, and let's say the share price of the company now is 10. So now we need to understand what is the market value of the company. So market value of the company is nothing but the number of shares times the share price. So this is the number of shares. So you've got number of shares here, and then you got the share price, and then you got the market value. So this is the market value, this is the number of shares. So now let's say the company is coming up with a 10% stock dividend. So there's a 10% stock dividend coming here, so which is going to be 100,000 times 10%. So that's going to be 10,000 shares. So the share price, what's going to happen is that the company is not going to charge any money for this because these are free shares issued to the shareholder. So it's going to be 0. So the market value of the company is going to be 10,000 times 0, 0. So now we need to understand what is the total number of shares. The total number of shares that you have is 100,000 plus 10,000, which is 110,000. And then you got your market value is still 1 million. So now I'm going to arrive at your stock price. So now how do you arrive at your stock price, guys? What do we do? Can you guys think about it? So what do we do? Now you got 110,000 shares, 1 million. So what we do is we divide your market value of the stock by the number of shares. So when you divide it by the number of shares, you're going to get 9.10. So what does that mean? What does that mean? 9.1 means the stock price, which was previously traded at $10, is now trading at 9.1. So the value of the company doesn't change. If you see 110,000 times 9.1, you still got the same value for the company. Let's say it's 1 million. So let's think about an investor. Let's say an investor have 1,000 shares. You are an investor X. Let's say investor X had 10,000 shares, which was previously valued at $10, which was valued at $10, 10,000 shares. So the market value is 10,000 times 10. So you got a total value equal to 100,000. That's what you had before. So now what's going to happen is that how many shares is he going to have after the stock dividend? How many shares the company is going to have after the stock dividend? You currently have 10,000 shares, and how many shares that you're going to have after the stock dividend? You're going to have 10,100 shares. That's exactly right, because you're going to have 11,000, I suppose, because this is a 10% stock dividend, isn't it, Ola? It's going to be 10% stock dividend, so that's 1,000 plus. So the stock dividends that is going to come in, new shares that are going to come in is 10,000 times 10%, so that's going to be 1,000 shares that is coming into effect, and the share price is 0. So the market value is going to be 1,000 times 0. So now, end of the day, what is the new number of shares that you have? 11,000. You can't be happy about it, because what happens after the stock dividend, your stock price is going to get diluted. It is going to dilute it to the extent of your revised share price. So your revised share price is going to be 9.1. So you have 11,000 shares, but each share is now worth only 9.1. Right? So when you multiply the number of shares by the revised share price, you are still going to have a value of $100,000. You had 100,000 before. Now you have many number of shares, but what does that mean? You have many number of shares, but end of the day, the market value, the total value of the company doesn't change, because everything going to get diluted. EPS is going to get diluted, your book value per share is going to get diluted, because there is no additional money coming into the company. So there is a dilution taking place. So that is why we say, whatever you do, stock split or reverse stock split, there is no change in the company's position. Right. We can also talk about a reverse stock split. So this is kind of a stock dividend or stock split. It works in the same way, but you could also do the same thing, create another sheet and try to understand how we do a reverse stock split. So what happens in a reverse stock split? The number of shares come down. Let's say a company had 100,000 shares at $10, and then they're actually making 50% reverse stock split. So what's going to happen is you're going to deduct 50,000 shares. So you're going to have only 50,000 shares. The share price is 10, so it's going to be 1 million. Now you're reducing it. So what is going to be your revised share price? Your revised share price now is going to be 20. So you still have the total value of the company is going to be $1 million, because there's no, you do a reverse stock split, but you don't pay any money. There is no cash outflow from the company. Remember, in a stock dividend, there is no cash inflow, and in a reverse stock split, there is no cash outflow. There is no change happening. So what's happening? If an investor has 10,000 shares valued at $10, now he's going to have how many shares? He's going to have only 5,000 shares, but it is valued at $20. So end of the day, his wealth does not change. So this is exactly what we are trying to demonstrate. So I'm actually going to go back now to the slides. So you have stock dividend, stock split, reverse stock split. So you need to understand there's no change in a company's value on these three. Right, so now we are actually going to talk about share repurchase. So what is the meaning of a share repurchase? Is that we have previously discussed this. If a company has excess cash, they can actually repurchase some of the shares from the market, which would mean the number of shares available in the market is going to go down. But remember, there will be cash outflow from the company. When the company is repurchasing the shares back from the market, they need to repurchase back at the market price. So when they repurchase back at the market price, there will be cash outflow from the company and the number of shares decrease. Now you need to understand, okay, what do you think are the reasons behind this? Why do you think companies repurchase shares? Can you think about any reasons why companies could repurchase shares? The company has got excess cash. Exactly, company got excess cash, they could revalue. And then as you say, the company wants to increase EPS maybe. Your company tries to increase the share value. That's a great answer. Because what happens if you if you purchase the shares, the number of shares come down and the share price go up. So trying to increase the share value, no projects to invest. Okay, now there is a question here. Can a company repurchase without investors' permission? Yes, they can. Right, it depends on the market regulations, right, in where you operate, and depends on your articles of association, market regulations. But obviously, if you are going to do a share repurchase, you need to get the shareholder permission to do that. So in that way, you are right. So without investors' permission, nothing can be done. It depends on your articles of association, the stock market regulations, which talk about share repurchases, as well as you need to get like exactly how, if you are paying a dividend, you need to get shareholder approval. So similarly, if you're doing a share repurchase, you need a resolution to be passed in your AGM or EGM for this type of things, right? So now the thing is, how do you think a share repurchase is going to help a company compared to a dividend? So why not the company can pay a large dividend to shareholders rather than pay a large dividend to shareholders rather than repurchasing the shares? This could be beneficial for investors when the tax on dividends is more than the tax on capital gains, because this goes as capital gains, right? If an investor has bought the shares at $50 before, now the company is buying it back for $60, so there is a $10 capital gain which the investor has to pay, isn't it? So when the investor has to pay a $10 capital gains, right, in this case the capital gain is going to be $10. If the taxes on the capital gains is lower than the taxes on the dividends, investors prefer share repurchase, because share repurchase would lead to a capital gain, not a dividend. So the tax differences between dividends and capital gains must be taken into account in deciding whether share repurchases are beneficial or not. And then again, there is also share repurchases is a signal that the shareholders, is a signal to the shareholders that the company believes that the stocks are undervalued, and that is why they are buying. You get the logic here is that, why do you think the company is buying back their own shares from the market? Because they think it's undervalued, so buying them is actually beneficial for them. It's cheap. So it gives an indication to the shareholders, the other people in the stock market, they could buy the company's shares because the management is buying, the company is buying, which means the stock is actually undervalued, right? It's not a guarantee, but it's just a view, right? Then can offset increase in shares outstanding due to employee share option scheme. Now, this is an interesting thing. Now, many organizations have ESOPs, employee share option schemes, which get released to the market time to time. So what happens is that your number of shares increase. When your number of shares increases every year, why? Because the employee share options are getting exercised. So when the new number of shares coming into the company, so what do you think is going to happen to your EPS? Can you think about it? What would happen to your EPS when new number of shares are coming into the market? Your EPS is going to go down. There is going to be a dilutive effect. So if a company wants to avoid this dilutive effect, what the company could actually do is to increase the number of shares outstanding. Decrease the number of shares outstanding by repurchasing shares equal to the new shares coming due to employee share option scheme to nullify the dilutive effect caused by employee share option scheme. So that is again something that you've got to remember on share repurchase. So this particular slide 85 talks about all the key terms that you need to know in dividends. If you are trading in the stock market, investing into stocks and you are receiving dividend, you need to understand all these terms which are important for you to trade in the stock market. Right, now, first of all, look at this. We are looking at a range of dates starting from August 25th until September 30. Right, we are talking about various days: declaration rate, ex-dividend date, right, holder of record rate, and the payment date. So you need to understand each of them properly, because there are situations in the exam they could actually ask to describe any of these. So a declaration date is the date at which board approves a dividend and the dividend is declared, right? So which means the date of declaration, the board is proposing and approving a dividend is, let's say, August 25th. Now, ex-dividend date, holder of record date. In some jurisdictions, ex-dividend date and the holder of record rate are one and the same. But in some jurisdictions, they are two different dates, but they are very close to each other. Meaning that, I mean, have you ever thought about, do you have to keep your money in the stock for the whole 1 year for you to become eligible to receive dividend? What determines your eligibility for dividend? You don't necessarily have to keep your money in a stock for 1 year to receive the dividend. You just need to keep your money, you have your name listed as a shareholder in the register of the shareholders at the ex-dividend date or holder of record rate in this case, right? Meaning, even if you bought the shares at August 30th of August, or you bought the shares of 10th of August, 10th of September, you still will be eligible for dividend, because at the date of this date, holder of record rate dates, they are going to look at what is the shareholders list. And they are actually going to look at the shareholders list at that date, paid dividends to all of them. Ex-dividend date is when, if you invest in the stock after this date, you will not be eligible for dividend, because on the September 15th, the stock price will come down logically to the extent of dividend. For example, let's think about an example. Your stock is trading at $15. So when the stock is trading at $15 now, and the company is paying a dividend of $1. So what happens is that the $15 includes a $1 for the dividend. So what happens on the ex-dividend date, the stock price becomes 14. Why the stock price becomes 14? Because if you buy the stock hereafter, you will not get $1 dividend, because you lose your eligibility to receive the dividend if you buy $1, if you buy the stock after this date. Another explanation to this is that when the company pays dividends, the money goes out of the company, so which means the value of the company drops. That's another way to justify why the stock price actually goes down. So when you buy that $14, the company pays $1 dividend, means that there is a cash outflow from the company to the shareholders, which means the value of the company drops. So whatever the logic that you want to understand that way. But remember, if you buy the stock after the ex-dividend date, you will not be eligible for dividend. What is the final date? The payment date, they are going to pay the dividend on the 30th of September, but based on the list of shareholders of the company as of September 17th, which is the holder of record rate. And in most cases, I have seen the ex-dividend date and holder of record date are one and the same, but there are circumstances that can differ. So meaning that you cannot buy the stock the day before, let's say 14th of September, and sell it on 16th of September. You buy it on 14th of September. You can sell it on 18th of September. Will you receive the dividend still? Can you think about this question? You bought a stock on the 14th of September, right? And you sell the stock on the 18th of September. Will you still get the dividend, yes or no? Think about it. You're buying the stock on 14th of September, but you're selling it on 18th of September. Will you still get the dividend? You will still get the dividend because you had the stock as of 17th of September. But if you buy the stock on the 14th of September and selling it on the 16th of September, will you be eligible to receive the dividend? If you buy the stock on 14th of September, no. You need to have the stocks on September 17 for you to become eligible to receive the dividend. So that is something very important for you to remember in terms of when you should buy. But now you can ask me a question. So it is easy to make money in the stock market. You buy the stock on 14th of September, sell them on 18th of September, just keep them for 3-4 days and sell them, you get your dividend. Is this right? Is my understanding right? No. Why? Why do you think this strategy is not going to work? That is exactly right. Your stock price is going to fall down to the amount of dividend. So what's going to happen is that you buy the stock at $14, say for example, you buy the stock at $14, you get a dividend income of 1, but you will end up selling the stock at 13. So what's going to happen in that case? Did you gain anything? Did you gain anything? No, nothing, because the stock price will reduce. So you haven't gained, but in fact you will be losing because you pay commissions and stock brokerage on the buying and selling. So you are actually going to lose money here, isn't it? So you got to remember about that. So you might lose money, but some cases, you know, still people like to do this and get advantage, because what could typically happen is that your stock is trading at 14, the company pays a dividend of 1, but after the X dividend date, let's say the stock price is trading at 13.2, because the market price doesn't exactly get adjusted to the dividend amount. So if it gets traded at 13.2, are you benefited by investing on the stock before the ex-dividend date? What do you think about it? How much is your cash inflow and how much is your cash outflow? How much did you pay for the stock to buy? How much did you pay for the stock to buy? You paid for the stock to buy, you paid 14. How much is your inflow? How much dividend did you get? 1. And how much, at what price are you selling your stock? 13.2. 14.2. So you actually benefited. How much did you benefit out of investing into the stock? You benefited 0.02 minus your commissions. Let's say your commissions is 0.1. So you actually made a return of 0.1 per share. If you follow this strategy, a lot of people follow this strategy, it can actually work in markets which are not very efficient. Right? So hope you understand this slide. This is very important from investing perspective. Right, now we are in slide 86, where we are going to talk about how do you value stocks using dividend discount model. So we are introducing the dividend discount model in this particular slide, slide 86. So we are going to see how to value the dividend based on dividend discount model. Always remember, the value that we are trying to value here is the intrinsic value. This is the value that you are going to estimate. And you assume that you are estimating the value of the company based on the expected future dividends and the expected future selling price. In this question of slide 86, we are talking about a 1 year holding period. Let's look at a question to see how it looks like. A stock paid a dividend of $1 last year and that will grow by 5% this year. You require a 13.2% return and you expect the stock price to be 13.45 at the end of 1 year. What is the stock's value today? So this is going to be our question. So how are we going to look at? Let's again go back to Excel. If we copy paste this question and try to see how can we work this out. See what's happening here. So what's happening here is that the stock currently last paid dividend is $1 and the dividend will grow 5% this year and you need a 13.2% return. So what does that mean that you need a 13.2% return? You need a 13.2% return means that your cost of equity is 13.2. So that's what it means. Your cost of equity is 13.2. That's your estimated rate of return. And also remember that dividend that is paid earlier is not relevant, because if you are investing in the company, the value of the company, its future cash flows, the past cash flows is not relevant. So we are going to actually look at the company paid a dividend of $1 and what's going to be the dividend for this year. So you have a $1 dividend, right? So you got a $1 dividend. So, and the growth of the dividend is 5%. So what's going to happen is that you got $1 and the growth is 5%. So that's going to be 1 times 1.05. So your dividend is going to be 1.05. Do you agree with me? Are you guys in the same page? The dividend for next year is going to be 1.05. Fantastic. That's exactly right. So now what are we going to do? And then you are also going to sell the share after 1 year. At what price are you going to sell the shares? After 1 year, at what price are you going to sell the shares? You're going to sell the shares at 13.45. 13.45. Yeah, you're going to sell the shares. So altogether, how much cash flow you are going to receive at the end of year 1? 13.45 plus 1.05. So you're going to get 14.5. This is exactly what you're going to receive. When are you going to receive 14.5? Are you going to receive 14.5 now or after 1 year? When are you going to receive? At the end of the year, your dividend is going to be paid at the end of the year, and then again, you're going to sell the shares at the end of the year. So 14.5. So 14.5 is the future cash flow, but this is not the value of the company because this is not the present value. So we need to arrive at the present value. So how do you calculate the present value? You take the value divided by 1 plus the discount rate. What is the discount rate? 13.2 to the power of what? To the power of 1. So what do you think is the stock price today? 12.8. 12.81 is the stock price today. Do you agree with me on this? What I did, I'm just dividing 14.5 divided by 1 plus 0.132 to the power of 1. You could also use your BA2 plus calculator to arrive at. You can say the future value is 14.5 and interest rate is 13.2. Compute present value, and the present value that you are going to get is 12.81. That's again a simple way of doing this, isn't it? Future value is 12.81 and future value is 12.81. Sorry, future value is 14.5. Interest rate is 13.2. Compute present value will give you 12.81. Now what you need to do? What is this 12.81? This 12.81 is the what it is. 12.81 is the, can someone answer the, can someone say the meaning of it? It's intrinsic value. This is what you should pay for the stock maximum, isn't it? Because You're estimating the future cash flow, discounting it, and saying this is the value of the stock. And then you're going to compare this with what? What are you going to compare this 12.81 with? What do you need to do? You're going to compare this 12.81 with the market price. You're going to compare this 12.81 with the market price. And let's say the market price is 11. The market price is 11. Is the stock undervalued or overvalued? The stock is undervalued because you can buy it at 11. And what are you expecting the stock to happen? What are you expecting the stock to happen? The stock price to grow. The stock price to increase to 12.81. And that is why you buy this stock. Hope you got that point. But suppose if the market price is 14, what do? If the market price is 11, then it is undervalued. Undervalued, so it is a buy. When the market price is 14, it is overvalued. What do you do if it is overvalued? You sell or short. That's exactly right. What if your market price is 12.8? What if your market price is 12.8? So basically, your stock price is trading at its intrinsic value. There are no trading opportunities. Some people call this is hold. It's just close to each other. So if you have them, you can hold, or if you have better investment opportunities outside, you sell this and get into something else. So this is something that you need to understand. Anything that we do in valuation, whether we are talking about a simple valuation like this, or whether we are talking about a complex free cash flow to the equity valuation, anything that you do, end of the day, the basic fundamental remains that we are trying to arrive at a value like this and compare that with the market value to decide if a stock is underpriced or overpriced. Depending on that, you're going to make your decisions. So I'm going to go back now to our calculations. So this is exactly what we did. So we got an answer 12.81. So I'm not spending time there. So we are actually now talking about multiple year holding period. So in multiple year holding period, what are we going to do? Again, we are going to look at another question, see what's happening here. In a multiple year holding period, let's take another Excel spreadsheet and see what happens here. In a multiple year holding period, so you see what's happening. So in the previous question that we did, what did we do? In the previous question, what did we did? The holding period is 1 year. So we estimated the price of the stock after 1 year. But in this case, we are getting a little bit more complicated here. So we need to understand the cash flows of the company. So we need to forecast the dividend for 3 years. So year 1, we need to understand what is the dividend. Year 2, we need to understand what is the dividend. Year 3, we need to understand what is the dividend. So what is going to be your dividend in year 1? Last year, they paid a dividend of 1.5. So how much is going to be year 1? Remember, year 1 is not the last year. A lot of people ask me these questions. If you go into any CFA forums, you see this question. People ask me, should I take 1.5 as year 1? No. Whenever they say the stock dividend paid, it is already paid. It is going to be paid is always year 1. So remember that if it is already paid, you look at it as it is historical. So you don't look at it. So what is the year 1 dividend? You're exactly right. 1.62, which is 1.5 times 1.08. And then again, next year, again, another 8%. You do it 3 times. And at the end of year 3, at what price are you selling your stock? At what price are you selling your stock at the end of year 3? 51. So would it be fine if I add a 51 here? Is this right? If I add a 51 here, do you understand what I'm doing here? Because that's going to be the cash inflow, because you can sell the stock at the end of year 3. So what do you need to do altogether? How much are you getting? You are getting 1.62, 1.75, 52.89. So you have 56.26. This is the total cash flow that you are receiving, but this is future value. So you need to discount them to arrive at the present value. So what we do, we take 1.62 divided by 1 plus 0.08 to the power of 1, isn't it? So we discount them. The discount rate is 12%. So thanks for correcting it. It's 12 because that's the discount rate. Your estimated or expected rate of return, or sometimes they call it required rate of return, is your cost of equity, which is 1.45. So you drag this down and then change this n to 2 years and this to 3 years, and then add them up. Sum 40.49. This is the present value of 56.26, isn't it? If you add this sum, this is the future value, isn't it? This is your future value, and this is your present value. Or we can call it intrinsic value, isn't it? This is the intrinsic value of the stock. So now, how would you make a decision? Would you buy this stock or not? Would you buy this stock or not? Or do you need additional information? Would you buy the stock or you don't buy the stock? You need additional information. You need to know the market price. Let's say the market price of the stock is 50. Then what you do, if the market price is 38, then 35, what you do? If the market price is 39.5, what do you do? If the market price is 50, is it overvalued or undervalued? What do you think about it? If the market price is 50, yes, it's overvalued. It's overvalued, sell short. If it is 35, undervalued, because you buy it at 35 and you expect it to go to 40. Yes, isn't it? Undervalued, you buy or go long. Okay, and then the market price is 39.5. What do you do? If the market price is 39.5, what do you do? I mean, it's pretty much not worth buying at now 39.5 when the stock market price is 40.4, because you just hold, or if you have better returns outside, you probably sell this, buy something else where you could make significant return, isn't it? So I don't really necessarily agree on something called hold as a recommendation, because it depends on other opportunities available in the market, right? So this is like, I would say, fairly valued. Your stock is fairly valued. Understand this terminology. When you say a stock is fairly valued, its value, the actual value, is close to the intrinsic value of the stock. So this is a multiple period holding period. So we looked at that example, how to do that. Try to do these questions on your own. So 40.5. Okay, now we are actually coming. So that's what your dividend discount model. So we are actually going to talk about dividend discount model in a short while. Here in these two examples, what we looked at, we have a defined or a finite holding period, isn't it? We said first we looked at 1 year holding period. We estimated the dividend only for 1 year. And then we said We estimate the share price at the end of year 1, add them together, discount them to arrive at the present value. In a 3-year holding period return, what we did, we forecasted dividend for 3 years, we forecasted the share price at the end of year 3, added all them and discounted them to arrive at the present value, and we said that is the intrinsic value. But usually we don't use those things in practice. What we practically do is dividend discount model, which is called golden growth model. So what we are going to do is we are going to actually forecast a company's dividends till infinity. Because the problem with other models that we spoke about in 1 year holding period, in 1 year holding period model or 3 year holding period model, what do you need to estimate at the end of the holding period? You need to know what is the value of the stock should be. So you should be looking at some other valuation models like multiplier approach or free cash flow approach or asset-based valuation approach anyway to identify that, isn't it? So that way it is not a full valuation model by itself. If you are to estimate at what price you will sell the stock in a year or in 3 years time, if you know that, I mean, there is no need even for you to look at a valuation in detail, isn't it? So in dividend discount model, we also call it golden growth model. We assume the company has an indefinite life and we forecast the company's dividend in infinity and then arrive at the company's value. We'll look at that short while. So what we are going to do here is that, we are going to look at free cash flow to the equity model. So what are we going to do is we are going to identify free cash flow to the equity. So now again, this goes back to what we discussed in FRA, free cash flow to the firm and free cash flow to the equity. What is free cash flow to the firm is cash flow from operating activities minus your free cash flow from your investment activities, meaning your capital expenditure. So CFO minus your FCI is actually going to give you but you need to add back the interest, minus interest minus, you need to add interest, net of taxes is going to give you your free cash flow to the firm. But here we are trying to calculate the free cash flow to the equity holders. CFO in the US GAAP firm is already after interest. So you don't have to additionally deduct interest. You deduct your CapEx. Free cash flow from investment activities is your CapEx. Plus net borrowing. Increase in the borrowing will be added. Decrease in the borrowing will be deducted. So this is the money available for equity holders. So what we are going to do is we are going to focus this value for the future until infinity and then discount them to arrive at a value of the company. So what I'm trying to tell you is in the dividend discount model, what we do, we forecast the dividends of the company for an indefinite period and discount them to arrive at the present value. And in free cash flow to the equity model, we use this model when companies don't pay dividend. There are companies, they don't pay dividends. If the companies don't pay dividends, can you use dividend discount model to value them? Because the notion of dividend discount model itself is that you value the company based on its expected future dividends. If there is no dividends, then you cannot use dividend discount model at all, isn't it? So something that is very important for you to remember on the dividend discount model, right? If the company is not paying dividends, so what you are going to do, you're going to do free cash flow to the equity. So you get cash flow from operating activities minus your CapEx plus net borrowing. You forecast this figure for each of the years until infinity, discount them all the way back to arrive at free cash flow to the equity value, and that becomes the intrinsic value of the company. And you can ask me, okay, how would I do this forecasting till infinity? how many years you need to do? No, we are going to use terminal value approach. What is terminal value approach? You know about how to calculate the present value of perpetuity. A present value of your perpetuity is the cash flow divided by the discount rate. We will talk about that in detail at that point in time. But remember now, when do you use FCFE? You use free cash flow to the equity. It reflects the company's capacity to pay dividend. It doesn't show actually how much dividend paid, but this is the dividend capacity. This is the maximum dividend the company can pay, because using this money, you have already paid interest, you have already paid for your capital expenditure. Whatever the money that you have, you can pay dividend. This model is useful when the company does not pay dividends. An analyst should need not to forecast the company's future dividends. So the company analysts have less trouble here, because dividend payout is something some companies openly say that they pay, let's say 50% of earnings as dividend. Some companies, they keep it as a secret. So when some companies keep it as a secret, analysts will find it very difficult to forecast the dividend payout and the dividend expected dividend. So in that case, free cash flow to the equity model can be particularly useful. Okay, now we are looking at preference stock valuation. Now we are trying to look at value of a preference stock. That's how do you value the value of preference stock? Look at this example. This is the easy thing to do in the exam. Look at it. A company's $100 par value preferred stock pays 5% dividend and has a required rate of return of 8%. So that is your cost of capital. Calculate the value of preference stocks. Let's say this is a irredeemable stock. If it is an irredeemable preference stock, the company is going to pay a dividend of $5. Till how many years are they going to pay this dividend? Till how many years this company is going to pay this dividend? Are you guys there? Infinite. The company is going to pay this dividend until infinity. So what is the value of this? We know from time value of money calculation in quantitative techniques, the present value of infinity is the value divided by the cost of capital. Yes. So what we do, the annual dividend is 100 times 5%, which is 5, which already given to you, divided by your cost of capital, that is given to you 8%, gives you 62.5. What is this 62.5? What is this 62.5 for these preference shares? Is the present value of infinity, isn't it? So this 62.5 is the intrinsic value of the preference shares, and then you are going to look at this, compare it with the market value to see if the stock is overvalued, undervalued, or fairly valued from a preference shares perspective. Because preference shares dividends are preference shares are easy to value. Why? Because they got a fixed cash flow, right? I mean, when you're talking about an equity dividend, which can't do this because you divide 5% by 0.08, you can ask me a question. Okay, the dividend is now 5, but what about next year? The dividend can grow. It can continue to grow. How to bring that into the model is going to be a question. It's going to be a challenge when it comes to ordinary shares, common shares. But preference shares, no, it's going to pay a fixed dividend divided by the cost of capital or rate of return. That's going to give you the intrinsic value of the stock. So don't go wrong here. This is a very popular questions in the exam and very easy to score marks. Now we are actually going to look at, again, this is getting more interesting, and I'm sure I discussed about this particular thing in Gordon growth model to calculate the value of a stock, right? This is the point here, which is your value of the stock is equal to D1, which is the dividend payable in a year's time, divided by cost of equity minus the growth rate. This is what we discussed. Here we are going to talk about it to identify the intrinsic value of a stock. But remember, we spoke about this in corporate finance to estimate the cost of equity of a company, isn't it? The same thing that we used. So we are going, this is called Gordon growth model, where you assume a company is going to pay a dividend, every year with a constant growth. So what we are going to do is we are going to use year one dividend divided by your cost of equity minus growth rate. Now, here you don't have that minus growth rate. That's the difference between these two, isn't it? Here we are not having a D1 and here we are not having a minus G here. Why is that? Why we are not using that? Can someone think about it logically for preference shares? Why there is no growth used here and why it is a fixed dividend, so you don't have to use any growth. But if you look at it here, we are actually going to take D1, cost of equity minus growth rate. That is going to give you the terminal value of the stock, and that is the intrinsic value. So let's look at this example. A stock paid a dividend of 1.5 per share last year, which is expected to grow at a rate of 8% forever. If an investor requires 12% return, what is the value of the stock today? This is what we are going to do. So you need to now tell me certain things. What is 1.5? Is 1.5 D0 or D1? The first question for you to remember. 1.5 is D0. Is that, can you use that directly into the question? No, you cannot. So you need to understand what is going to be D1. D1 is going to be 8% growth. So 1.5 times 1.08 is going to give you the dividend for D1. So if you specifically want to identify that, how much is that? 1.5 times 1.08 gives you 1.62. Yeah, the dividend is 1.62. So that is which year's dividend? That is which year's dividend? That is next year's dividend, D1, divided by the cost of equity, which is 0.12, because this is present value of perpetuity. How to calculate the present value of perpetuity? Cash flow divided by estimated cash flow divided by cost of capital, which is cost of equity here. Why cost of equity? Why not WACC? Can someone answer this question? So this is always a question that can come up now. Why we are talking about WACC for projects, but here we are talking about cost of equity, because what are we trying to value? We are only valuing equity. That's exactly right. So use cost of equity minus your growth rate. So what is this minus growth rate? This is going to take care of the growth until infinity, because every year your dividend is going to grow 1.62. Next year it's going to be different. Next year it's going to be different. It's going to continue to grow in infinity, isn't it? How to take care of that in your equation? You cannot adjust the numerator, because if you are adjusting the numerator, how many iterations you have to do? And you don't even know when to end, because it is infinite. So easy way to handle that is adjust your discount rate. Reduce your discount rate to the extent of growth. So now I have a question for you. The growth, will it increase the intrinsic value or decrease the intrinsic value? Look at interpreting. So interpreting is a learning outcome statement here. So you need to understand, if you are increasing the growth rate, what's going to happen to the intrinsic value of a stock? What's going to happen to the intrinsic value of a stock? If you are increasing the growth rate, is obviously the logic, it should increase, because this lower the discount rate, higher the intrinsic value, higher the present value. Or if your growth is more, potentially it's going to turn into better dividend in the future. So that means the value is actually going to increase. So you're right, exactly. When higher the growth rate, higher the value of the company. And also you think mathematically, if you want to understand, you are dividing a number by by a lower number, because we are increasing the growth rate and the growth rate gets deducted. So you're dividing it by a higher and lower number. So when you divide it by the lower number, the value mathematically increases the value of a stock. So see what's happening. This is a very important formula, not just in level 1, for everywhere. So you've got to remember D1 divided by cost of equity minus the growth rate. And this is going to be the intrinsic value of the company. And if the stock price is trading below this, it is undervalued by them. If it is trading over this, it is overvalued. You sell them or short them. So that's Gordon growth model. Right, now you need to understand. I'm going to ask you a question. Logically, what do you think is the value related to the growth? Now I asked you a question. If you are bringing in growth, what will happen to the stock price? And you cleverly answered, the stock price is going to go up. Higher the growth, higher the dividend, higher the future dividends, which means higher the value of the stocks, logically, right? But if you think about what value is related to growth, it's easy to do that. Do something without growth. Do something with growth you already have done. Do something without growth. Divide 1.5, which is last paid dividend, by 12%. 12% is your cost of equity. Your stock's dividend, your stock's intrinsic value is 12.5. This is like how you would be valuing a preference shares, isn't it? Look at this. Now we are calculating value of the company due to growth is, the present value is 40.5. So 40.5 minus 12.5, there is a $28 value which is created through applying growth into the formula. You applied growth twice. You made D0 D1, and then you made cost of equity from 12%. You reduce the cost of equity to 4% because 0.12 minus 0.08. So that's the Gordon growth model on the dividend discount model. So that's where we stand at the moment. We are on estimating the value of G. So we look at estimating the value of G, and then we will go on to slide 100 after the break. So we look at this now. This is interesting, and I'm sure you guys already know this because I spoke about how to estimate the G, growth rate. So how do you calculate growth rate? Is retention ratio times return on equity. So higher the amount of money that you retain in your business or reinvest rather than pay out as dividend, your growth rate is actually going to increase, isn't it? Do you logically understand that if you reinvest, companies which reinvest more money will have historically greater growth rates? So that's the logic. You multiply the retention ratio by return on equity, you're going to get the sustainable growth rate of the company. This is one way to identify the growth rates in this question. If you see here, how will you get 8% growth rate? In this case, it is given to you, but practically, if you are valuing a stock, you need to know the growth rate. You need to calculate. In an exam, they might give you, or they might ask you to calculate based on your this formula, RR times ROE. But practically, you would have to anyway do it. So what is your retention ratio? Retention ratio is 1 minus dividend payout ratio. If the dividend payout ratio is 60%, what is your retention ratio? If your dividend payout ratio is 60%, your retention ratio is actually 40%, isn't it? It is 40%. So that's how you decide your retention ratio. And how, now the next question is, how do you calculate dividend payout ratio? Your dividends divided by earnings. On your earnings, how much you are paying out as dividend and how much you are reinvesting. So that's basically your dividend payout ratio. Another way to calculate is DPS divided by EPS. Dividend per share divided by EPS is same like you do dividends, total dividends by total earnings. It's because DPS is Dividend per share, dividends is the total dividend. EPS is earnings per share, and earnings is the total. So it's the same thing. You take dividend divided by total earnings. So you divide EPS by the EPS, is actually going to give you the same answer. So higher the retention, higher the growth rate, higher the ROE, higher the growth rate. But higher dividend payout ratio, what would be the impact on company valuation? What would happen to the value of a company if the dividend payout ratio is more? From a growth perspective, what do you think is going to happen to the company's value if dividend payout ratio is more? It's going to have an impact. It's going to have a negative impact because of lower growth, because the dividend payout ratio is more, means the retention ratio is less. So what are we going to do? In this case, Green Incorporation is expected to pay dividends equal to 25% of earnings. Green's ROE is 21%. Estimate Green's growth rate of dividends. So what are we going to do? Your retention ratio is 1 minus 25%, which is 75. And then you got 75 times 21, which is ROE, gives you 15.75. So that's going to be your sustainable growth rate of the company. So that's the end of growth. This is a very important formula, and this is a very important lesson what we discussed today. So remember that. So now it's 6 p.m. So I'm going to see you exactly at 6:15. And to get going with, we got more exciting stuff to come. We're going to talk about multi-stage dividend discount model, and then we are going to use 2-stage, 3-stage, when to use, and then we are going to get into something more exciting, which is multiples-based approach for stock valuation. Okay, guys, so I'm going to see you shortly after the break. We'll meet up at 6:15 p.m. Let's get back to the rest of the valuation techniques. So we discussed about single period dividend discount model. So in a single period dividend discount model, what we do is we take D1, which is the dividend, next year dividend, divided by cost of equity minus growth rate, is going to give you the value of the company. So that's going to be the single period determining the intrinsic value in a single period dividend discount model. So now what we are going to do is we are actually going to look at multi-period dividend discount model. Right. So look at this question. A stock is expected to begin paying dividends at the end of year 4. The first dividend is expected to be 0.82, assuming a constant growth of dividend of 5% and required rate of return of 10%. Estimate the value of this stock. So that's exactly what we are going to do here. So let me take this into an Excel spreadsheet to help you understand what we do in this case. Okay, look at this. What's happening here? The company, if you think about, if the company is just going to pay a dividend of 0.82 and then the growth rate is 5% and required rate of return is 10%. So it's easy to estimate the intrinsic value, isn't it? How we are going to do is what's going to be a D1. The D1 in this case is going to be 0.82. There's nothing for you to do about it because 0.82 is the next year dividend. It's not going to be the last paid dividend. So you got to remember the dividend, if they say the last paid dividend, then you apply the growth for that. If not, you don't. So 0.82 is already with 5% growth. So what you do is 0.82. You do 0.82 divided by cost of equity, which is 10% minus the growth rate, 5%. So this is going to be the value of the stock, isn't it? 0.82 divided by 0.1 minus 0.05 gives you the value of the stock, which is 16.4, right? But the problem is, if you really understand this, the first year dividend is the year 4 in this case, because the company is going to company is not going to pay any dividend for the next 3 years. The company is going to start paying dividend only from year 4. So if you are going to use year 4 as D1, so if you really look at the formula here, your formula is actually D1 divided by cost of equity minus growth rate. So this is what we are going to do. So in this case, your D1 of 0.82 is actually D4, isn't it? So the value that you arrive, 16.4, is it present value, or is it value in year 4, or is it value in year 3? Okay, try to answer this question. This is a very important question that you need to understand for you to be able to understand the whole thing properly. End of year 3, it's not year 4, because think logically, it's not year 4 value. So this is where a lot of people get confused. It's not year 4 value, it is year 3 value. Why? If you really look at the normal formula, D1 divided by cost of equity minus growth rate. So when you use D1 as a dividend, what is your answer? The value that you derive is D0 or D1? Okay, this is a question that you need to answer to get this concept clear. D1, when you are using D1 in a normal question, forget about this question. This is a bit complicated. Forget about this and try to understand a normal question. How you do dividend discount model, D1 divided by cost of equity minus growth rate. D1, is it last year dividend or next year dividend? What is D1? D1 is next year dividend. So if you are using D1 in your formula, the value that you generate, is it P note or P1? Are you going to get the price in first year, or are you going to get the price in today? What are you going to get? The price that you are going to get today is what that is. So if you are using dividend as D1, the price, the intrinsic value that you generate is today. So D1 is D note. So think about it. If you are using D4 as D1, the price that you are going to get, the intrinsic value 16.4, is it D4 or D3 or D0? Sorry, is it P4 or P3 or P0? It is actually P3. Right, so my right question should be whether it is P4 or P3 or P note. It is going to be P3, because if D1, if you are using D1, you are getting P note, intrinsic value today. So if you are using year 4 as D1, the intrinsic value you are going to get is at the end of year 3. So that's what it is. So what you need to do now, you get the value 16.4, which is the intrinsic value in year 3. So if I write this, this is the intrinsic value at year 3. At year 3. So now what you need to do, you need to further discount today. Bring that back into today's value. So I'm going to say intrinsic value at year 0. So what I'm going to do, discount this 16.4, basically 16.4 divided by your cost of capital. What is your cost of capital here? Your cost of capital here is going to be 10%. So when you're discounting it, 16.2 divided by 1 plus 0.10 to the power of 3. So this is what we are going to use. So what I'm going to do is I'm going to say you have 16.4 divided by 1.1 to the power of 3. That's going to give you 13.32. So what is this 13.32? This 13.32, is this the intrinsic value in year 1, year 0, or year 3 or year 4 when it is, what is this? This 12.32. Yes, 12.32 is P0, which is the intrinsic value of the stock in year 0. So that's what you need to do. So you need to understand this. So I'm going to now go back and show you the logic. So you see what happened, 16.4, and then you discount that back to 12.32. So the question is, why we use 3, why not 4? Because when you use D1, you get P0. So if you use D4, you get P3. So when you get P3, you need to discount it by 3 years. You don't need to discount it by 4 years. Hope this makes sense. This is the most important thing that everybody gets confused. Make sure you are on top of it. Okay, multi-stage dividend growth model. So I'm actually going to tell you what happens in a multi-stage dividend growth model is that, let's say a company is going to have an abnormal period of growth in which the company is going to pay a very high dividend, and after which period the company is going to pay a normal dividend for the infinite future. So in that case, how do you calculate your intrinsic value of a stock based on dividend growth model is what we are actually going to look at. So look at, in this case, the company paid last year dividend of $1. Dividend will grow at 15% for 2 years. Dividend will grow at 5% after 2 years in infinity, and the rate of growth is 11%. Though this is a little bit tricky, and this is the only thing that you need to know in a multi-stage DDM model. If you understand this, a lot of things will fall in place handy, and this is going to be even very useful for you to understand materials in level 2. So I'm going to get this question pasted into the Excel as well. So let's try to understand what to do now. Now, last year's dividend, we are not going to take that up in our calculation. We only need that to understand next year's dividend because that is past. The value of a stock is nothing but its future cash flows, isn't it? How much will you pay for a stock today is how much the stock will pay for you tomorrow, isn't it? Anything for that matter. I mean, think about valuation as a practical element in day-to-day life. Anything that you want to buy, you want a calculator, you want to buy a smartphone, you buy anything in your life, you always try to see what is the real value is of this and how much value I'm going to derive by using this and what is the cost of this. And when are you going to buy it? You're actually going to buy it when the derived benefits of that particular item that you are buying is actually more than the cost that you would be paying, isn't it? So apply the same principle in any type of valuation of equities, valuation of fixed income, valuation of real estate, anything that you value. End of the day, the concept or the notion on which you look at things is the same. Okay, look at this. Last year's dividend is $1. Dividend will grow at 15% for 2 years, right? So, and then it's going to stabilize at 5%. So can we first look at year 1 and year 2 dividends here? Can you guys help me to do that? So your year 1 dividend, how much that's going to be? Year 1 dividend is going to be $1 times $1 times 1.05, isn't it? So I'm going to put that. So that's going to be $1 times 1.05 is going to be 1.05. So that's going to be, sorry, 15%. It's not 5%. So it's going to be 1.15. So the dividend is going to be 15% because it's having an abnormal growth in dividend. And remember, maintaining such abnormal growth in infinity is not possible. Maybe the company is paying abnormal growth of dividend. Maybe these 2 years is exceptionally good for them in terms of higher profits, but which will not happen after some time, right? So it's going to be 1.15. And then the year 2 dividend is basically now we're going to do 1.15 times 1.15 again. So what we are going to do is 1.15 times 1.15. It's going to be 1.3225. So this is going to be year 2 dividend. Now, what we are going to do is we are going to bring these cash flows to present value. So what are we going to do? So this is the future value, isn't it? This is actually the future value. This is your future value. This is your future value and this is your present value. So what you do, you divide 1.15 divided by the discount rate is 11%, cost of equity, 1 plus 0.11 to the power of 1. I discount this dividend and then I discount this dividend as well. That's to the power of 2. And then now I need to arrive at a terminal value. What is this now? You need to understand this word that I'm using. Terminal value is the dividend starting from year 3 until infinity. The value of that using simple dividend golden growth model will give you the terminal value, right? So what I'm going to do, what is your year 3 dividend? What is your year 3 dividend is going to be 1.32 times 1.15. So that's going to be how much? It's going to be this times 1.15. This is your D3. So I'm going to use D3. So what I'm going to do here, I'm going to arrive at the terminal value here. How I will calculate the terminal value, I'm going to do, this is what I'm going to do. I'm going to do 1.521. Yes, that's your D1, D3 becomes your D1 divided by your cost of equity minus the growth rate, because the dividend is going to grow by 5% in infinity. So what I'm going to do is I'm going to take this divided by cost of equity minus growth rate. You are going to get a value of 25.3479. So now, if you have understood all what we have studied so far, you need to tell me now. Okay, that's a very good spot. What you have mentioned is correct. Year D3 is supposed to grow at 5% from thereafter. So I made a mistake here. This is one of the common mistakes what people make. So it's going to be 1.05 because we need to look at what is your sustainable dividend growth. So basically that's going to be 1.32 times 1.05, and then here again to make it consistent I change the signs here, so you get this. So this is should be 1.05, so you get 23.1438. So now you got to tell me something. This 23.1438, is this the value in year 0 or year 2 or year 3? Is this the value in year 0 or year 2 or year 3? Are we all in the same page? Do we all agree that the value that you derive from this calculation, the 23.1438, is year 2 value? Why is this year 2 value? What is the dividend you are using for this? Which is the first year dividend you are doing? What is your D1? The D1 is D3, isn't it? D1 is D3. So your P0 is going to be P2. So the price that you are generating is 23.1432. So now a lot of people make a mistake here. Not just, I'm not talking about people making mistakes in the CFA exam. That is one thing. A lot of analysts make this mistake. What they do is they say the value of this company is 23.14, 1.03, 1.07. Is this correct? Did I do something correct or did I make a mistake? No, I made a mistake. What am I supposed to do? What am I supposed to do? 23 terminal value should be discounted. That's precisely right. So we need to now discount the terminal value. By how many years you need to discount the terminal value? Don't forget to discount terminal value. A lot of analysts don't discount terminal value, which is a mistake because this terminal value is not now. This terminal value is after some time. So what are we going to do now? What are we going to do here? is that we are going to do 23.143 this divided by 1 plus 1.11 to the power of 2. So you have 18.784, and then the intrinsic value of the company, pay attention now, intrinsic value of the company is the present value of year 1 dividend, present value of year 2 dividend, and present value of the dividends from year 3 until infinity discounted to year 0. And 20.8934 is the intrinsic value of the stock. Is this clear? Do you have any question here? Do you have any question? Does it make sense? Does it make sense what exactly we did? I mean, if you understand this, you understand the complete logic behind multi-period dividend discount model. So that's going to make things a lot easier for us in so many places. I'm going to go back here. So see what's happening is that you forecast dividend 1.15, 1.32, and then you apply 1.39 will be your year 3 dividend, 5% growth. And after that, your dividend will grow at a constant rate. First 2 years, you have a normal period of growth. After that, you have a constant growth. So that's why we call it a multi-stage. There can be more than 2 stages. It can be first 2 years, 15% dividend, second 2 years, 10% dividend, and then a constant dividend growth. If the examiner wants to give you a lot of work in your calculators, then they can do that, but highly unlikely. What I normally see is a 2-stage dividend, like what we did now. So what's happening here in the step 2, what you're doing is you're going to take 1.32 divided by 0.11 minus 0.05 gives you 22. You further discount that all the way back to year 1. So that's going to actually give you 20.86. Right. So that's basically what we did. Did we get a correct answer in our Excel spreadsheet? Yeah, 20.8934. That's the value of the company. You get this? 20.89. So see what's happening. This is the first year dividend discounted for 1 year, second year dividend discounted for 2 years. Then you have the terminal value 23.17 based on the year 3 dividend further discounted back to year 0. That's what we are trying to do here. So 1.15 discounted for 1 year, 1.32 discounted for 2 years, then 23 is your terminal value at the end of year 2. Discount them all the way back to year 0, you get 20.91. So that's multi-stage dividend discount model. So now again, slide 107, we are trying to see when can you use dividend discount model in practice. In practice, we use dividend discount model for stable and mature firms who pay stable dividends. We cannot use dividend discount model for cyclical firms. What are cyclical firms? Their cash flows are cyclical. They are volatile in line with the trade cycle. If you have economic cycles like boom and recession, your cash flows will be volatile. When the cash flows are volatile, your dividends are going to be volatile. So when the dividends are volatile, we cannot use a constant dividend discount model to estimate the terminal value. So that is why this dividend discount model in practice is limited to stable and mature firms and non-cyclical firms who are expected to pay a constant dividend with a constant dividend or a constant growth in dividends. Both are okay, but if you have volatile dividends, like 1 year is 10, the next year is 5, the next year is 2, and then going up to 15, then it doesn't make sense. You cannot use dividend discount model for such companies. right? So two-stage dividend discount model, three-stage dividend discount model, you can use them. You first, maybe you don't have a dividend for first 2 years, and then dividends grow by 10%, and then it grows by 15%, then it gets stabilized. There's so many ways that you can bring in, but the methodology that we use is actually the same, right? So that's the end of discounted cash flow models. Right, now I'm going to tell you one more thing before we go into price multiples. I would want you to think about something else before getting into it. So we also said, if companies are not paying dividends, how would you calculate, how would you use the discounted cash flow approach to value the identify the intrinsic value of a company? Can you think about it? If a company is paying a dividend, you could use dividend discount model. But if the company is not paying dividends, so what are you going to do? How best can you identify the present value of the cash flows? Remember, we said that we are going to use something. If the dividends are not paid, or if the dividends are volatile, what can you do about it? What can you use as a substitute for dividends? What can you do? That is exactly right. You're exactly right. We're actually going to use a free cash flow to the equity. So how I'm going to do that, I'm going to show you. Okay, this is how most of the analysts value companies based on free cash flow to the equity, right? So now let's say you are forecasting your operating cash flow. You forecast it based on your various assumptions on revenue and operating expenses, working capital changes. I don't want to talk much about that. You are estimating that for year 1, year 2. Usually the practice is analysts estimate this for 3 years, right? Then, for example, year 0, 1, let's say you have 1,500 is your operating cash flow. So year 1, you expect it to grow by 10% based on your projections. How you arrive at it? Based on your financial model. So this is why analysts use financial models to do this. Are you able to see my Excel sheet now? Yeah? Are you able to see my Excel sheet? Okay, fantastic. So I'm applying a 10% growth because this is the best information, let's say, the analyst has got. And then year 2 is expecting it to grow by 8%. And year 3, you expect to grow by 7%. Okay, now we need to first identify, okay, let's say what is your cost of equity. So before that, you need to deduct your CapEx, your capital expenditure. Let's say capital expenditure is like, let's say 10% of your cash flow. 10% of your cash flow. So that's going to be 190.7. And then do you have to deduct interest? Yes or no? Do you have to deduct interest for FCFE? When you are starting from operating cash flow, do you have to deduct interest to arrive at free cash flow to the equity? Free cash flow to the equity is after interest. In IFRS, yes, that's a great answer. In IFRS, yes, because in IFRS, if the interest is not part of your operating cash flow, if it is part of financing activities, then you will have to add back, you will have to deduct, so you will have to deduct the interest. But in this case, you don't have to deduct the interest. Why you don't have to deduct the interest? Because we assume it's US GAAP and interest is already deducted. Your CapEx is 165. I assume it's 10% of your operating cash flow. So, and then increase in net debt. Increase in net debt, I assume it to be 0. Most of the analysts, they assume this to be 0, by the way. So you say this is 0, right? And then you say, what is your FCFE? So that's going to be sum of this. And then sum of this. So let's say your cost of equity is 15%. So what you need to do, you need to discount this by 15%. So that's going to be this divided by 1 plus 0.15 to the power of 1. This is the discounted value. Drag them all the way here. And then this is going to be 2 years. And this is going to be 3 years. So this is going to be, I'm going to say, present value of FCFE year 1 to year 3. So what are you going to do? So you're going to sum it up. You're going to say, add these 3 together. Okay, what if I try to say, okay, this is the value of this company. This is the intrinsic value of this company. What I am missing here? I'm missing a bigger piece of information here. What is that I'm missing? I'm forecasting year 1 cash flow, year 2 cash flow, year 3 cash flow of free cash flow to the equity and discounting them and saying this is the intrinsic value of the company. What is the biggest mistake so far that I have encountered, I have made here? What did I ignore? Did I ignore something? That is exactly right. I have ignored the cash flow of this company from year 4 until infinity. Isn't it? Here I am trying to argue the value of company is year 1, year 2, and year 3. But is it that right? Is this company has a useful life of 3 years? No. If this company has a lifespan of 3 years, then it's fine. But if the company doesn't have a lifespan of 3 years, or it has a lifespan of until liquidation in infinity, so which means what we do is we value this company in infinity, we need to arrive at terminal value. So what we are going to do is we are going to forecast year 4 cash flow, and that's going to be the start of your terminal value. And let's say your operating cash flow is, I'm taking a random number for a normalized number, and then I'm going to say your capex is 200, and then you have a cash flow of 1.8, and then I arrive at the terminal value. So how would I arrive at terminal value? I take 1.8, and what I do, can you guys think about it or ask me questions so I know you are in the right stage in becoming an equity analyst, if not a valuation guy? Okay, 1,800 divided by 0.15. Is it 0.15 Lambo or yes, 0.15? Yeah. So 1.8 million divided by 0.15, but then you are ignoring the growth from year 4 until infinity. Let's assume the company's free cash flows are going to grow at 5% until infinity. So what we need to do is I'm going to take 1.8 is year 1 is D4, so it's already 5% is applied, divided by cost of equity 0.15 minus growth rate 0.05. And how can you estimate that growth rate? I'm trying to think if you are able to connect things together. How can you come up with a growth rate here? Can someone give me an idea? I don't know. I used a 5% growth rate arbitrarily, but maybe I have a better way of using it. The payout ratio equation. How do you do it? Your retention ratio times your ROE will give you a growth, and you can do that for the company and use that. This is what they teach you in financial modeling class, by the way. But you just have to understand how to forecast operating cash flow, and the rest of the things anyway we are discounting, we are talking about it here. So what we do here, you have 1.8, and then your cost of equity minus growth rate gives you 18,000. So okay, again I'm going to tell you, is this correct? I'm going to add all this. Is this right? Can I say the intrinsic value of this company is 21,632? what is the mistake I have made? I just want to check again if you got the fundamentals of valuation correct. That's exactly right. Your terminal value is 18,000 is as of which year? This 18,000 what you have gotten here, the value of your terminal value, the present value of infinity, this is as of which year? Year 3, because you are using year 4 means you are getting it year 3. So you discount further to arrive at the present value. So I'm going to say here present value of terminal value. Present value of terminal value is basically you are going to take 18,000 divided by 1.15 to the power of 3. So that's here. I'm going to also write the formula for you. So this is 18,000 divided by 0.15 minus 0.05. This is what we calculate this, isn't it? So now we are going to do total value of equity. So what I do, I'm going to add this plus this. So you have 15,467.64. Number of shares, number of common shares. Let's say 10,000. 10,000 is the number of common shares in the company. So what you do now, I'm going to say intrinsic value per share. That will be 15,467 divided by 10,000, 1.54. This is the intrinsic value. This is the free cash flow based intrinsic value. So this 1.55, what do you think is this? The intrinsic value. So you need to come intrinsic value as of which date? 1.55 is the intrinsic value as of which date? The final today, exactly. So what are you going to do as an analyst? You think this is the value of the stock. Currently your stock price is trading at $1. So you got a shock. There is 55% upside, meaning that this stock is deeply undervalued. You immediately issue a buy recommendation that this stock is going to go up by 55%, but make sure your projections are correct. Make sure that you are not understating your cost of equity. Make sure you are not overstating your growth rate. Make sure your operating cash flow for year 1, 2, 3 projections are realistic. Then if all of them are kind of in line with what somebody can realistically project, then probably this stock is really deeply undervalued, isn't it? Because it's trading at $1, but the intrinsic value that you arrived at for the stock is 1.55. And why we are dividing it by number of shares? Because we are doing this calculation for the company and then dividing it by we are trying to do it for the total equity and divide it by the intrinsic value. All right, that's interesting. So I'm going to now go back. So this is, when do we use this approach? When do we use that approach, guys? When do we use that approach? When dividend, if a company is not paying dividend, exactly, when the dividend information is not there, dividend, actually the company is not paying dividend, or it's not a mature company, the dividends are volatile, then you can use that. And I prefer free cash flow to the equity approach more than dividend discount model. Right. So moving further down, now we are actually moving to price multiples approach. So before getting into these topics here, I'm actually going to look at various types of price multiples, and we are going to learn to calculate what that means, how to calculate them, what it means, how to interpret them, whether it is overvalued or undervalued, how to understand is what we are going to talk about. First, what we do, PE ratio is stock price divided by EPS. EPS is total earnings divided by weighted average number of shares, and you know from FRA how to calculate your EPS. So from an equity perspective, they give you the EPS. They don't complicate by combining FRA EPS calculation into this. Price to sales, what is this happening here? Price to earnings, price to sale means your revenue of the company divided by number of shares will give you sales per share. So stock price divided by sales per share. So this ratio is actually going to be lower than the PE ratio, because obviously sales is the top line in a P&L and earnings is the bottom line in a P&L, isn't it? So your sales per share is always higher than your revenue per share, sorry, your earnings per share. So which means your PS ratio tends to be lower due to higher denominator effect. And price to book value, how do you calculate book value of a company? Where will you find it? Where will you find it? We already discussed about this. Where do you find the book value of the company? Book value of the company, where do you find it? In the balance sheet. That's exactly right. Your net assets divided by number of shares. That's exactly right. That's your total net worth. Equity value divided by number of shares is going to give you price to book, and you're going to compare the stock price with the book value. Price to cash flow, then you identify the total operating cash flow or free cash flow, whatever cash flow you are looking at, use consistently. Take the total cash flow divided by number of shares is going to give you cash flow per share. Divide the price by cash flow per share is going to give you price to cash flow. So in all these multiples, whatever approach that you use, you're going to take the price as a numerator. The denominator will be the KPI that is under consideration, either EPS, sales per share, book value per share, cash flow per share. Okay. So now that's what it is. So now this is the assumption of anything that we do. We say if you are talking about two companies in similar industries, similar size, when you are comparing two of them, they should have the same multiple. Meaning if their EPS is 2, if one company's EPS is 2, and if the multiple is 5, they should be trading at 2 times 5, $10, right? The price is a function of EPS and the multiple. How many times over the EPS the stock is trading? Suppose if the stock price is 10, EPS is 2. What is your multiple? Can you think about it? Price is 10, EPS is 2. What is the multiple on which it is trading? It's trading at 5 times the EPS. So what it means, if your EPS is 2, multiple is 5, so the price is 10. Why? 2 times 5, 10. So if a company in the similar industry making an EPS of 3, what should be their share price? If a company has an EPS of 3, what should be their share price? 15. There you go. Because the multiple is the same. It is a multiple means how many times you are paying more than the value. Because if you take about your cash flow per share, PE, EPS, cash flow, all of them is for 1 year, isn't it? Except for the book value, which is a balance sheet measure. The rest of the things are for 1 year. EPS is for 1 year, cash flow per share is for 1 year, sales per share is for 1 year. So how many times you are paying a premium to buy a company? When the EPS is 2, you're paying 5 times premium. So 2 times 5, $10 is the price. So now we are actually going to, the logic is that if companies are trading at a lower price to book value, lower PE, lower price to sale, that suggests the stock is undervalued because you are paying less premium to buy them. Do you get the point? Do you want to pay less premium or you want to pay more premium? If I ask you a common sense, if you're buying something, an asset or an equity asset or a fixed income security, whatever the security, whatever you buy in the market, not just investments, anything that you buy in the market, would you like to pay less premium to buy or more premium to buy? When do you consider it to be cheaper? You want to pay less premium. That is why lower the multiple is better for your investment. It's a better investment opportunity, unless if the company is trading so at a low price to book value multiple or low price to earnings, because the company has got a hidden issue. They've got a hidden issue and nobody wants to buy the company's shares. Obviously, you cannot think it is trading at a lower price to book, so let me go and buy it, because you know why it is trading at a lower price to book. If companies are trading at a higher multiples, if you know they are trading at higher multiples, you still might buy them. For example, Apple. If you think about Apple share, it's trading at an above industry average multiple, but people still buy it because there's a lot of investor confidence in the stock. So people are prepared to pay a higher premium to buy them. But if you think about some stocks where the company management is bad, there's a lot of issues going on, the company's financial reporting quality is bad, so a lot of things are going on. So those companies usually trade at a lower premium to EPS or price book value or whatever you take. But does it mean that they are undervalued? You will go and buy them? Will you go and buy them just because they trade at a lower price to book value multiple? That's a starting point, but you need to assess further factors, isn't it? Okay, let me ask you a question. You are looking at two companies, similar fundamentals, similar business model, similar size. One is trading at a lower multiple compared to other one. There are no hidden problem in the company. Which one would you invest your money on? Would you invest in the one with the higher multiple or the one with the lower multiple? Which one are you going to invest your money on? Which one are you going to invest your money on? You are going to invest your money on the one with the lower multiple, because lower multiple means you are paying lower premium to buy the stock. So that is better for you. But remember, this is relative valuation. Why we call it relative valuation? Because we are going to value one company based on the multiple of something else. We cannot arrive at an absolute value like what we arrived at in dividend discount model or any of the discounted cash flow models. All right. So let's calculate, let's get into these numbers and try to understand how to do it. So can you guys help me to think about, help me to do this? How do we get PE first? Okay, let's look at PE first. When you want to calculate PE, what do you do first, guys, here? Can you tell me what do we do first when you want to calculate your price earnings ratio? Look, let me do that. So let me copy this and paste it into an Excel sheet and see how we could do it. There you go. I got them into the Excel sheet. So what are the things that you need to calculate is PE, price to cash flow, price to sales, price to book value. So what are the things? PE, we want to calculate PE, and then we want to calculate price to book, and then we want to calculate price to cash flow, then we want to calculate price to sales, isn't it? Okay, but can we first look at price to PE? So if you want to calculate PE, how would you calculate PE, guys? What are the two important variables that you need? You need to know EPS and the stock price. Do you know the EP? Do you know the stock price? Is it given to you? Is the stock price given to you? Yes. So what would you do? What would you do? EPS, how would you calculate it? How you calculate your EPS? 3.2 million, which is your net income divided by the shares outstanding. Exactly. So first let's calculate the EPS. Let's calculate the EPS. So EPS is going to be your net income 3.2 million divided by number of shares outstanding. So that's going to give you your EPS. So EPS is going to be 0.71. Okay, and then then what is your price? This is your EPS, and then here we have your price. So what is your price? Price is 11.4. I'm calculating it for 20x3. Okay, keep that in mind. 20x3 is what I'm calculating now. So price is 11.4, EPS is 0.71. And so what's going to be your PE ratio then? Multiple. I'm going to get the multiple, which is PE here, which is going to be price divided by your EPS. Okay, 15.9, 16 times. Okay, now number 2. I'm going to calculate the price to book value. So book value per share. Book value per share. How do you calculate it? Can someone tell me how do we calculate the book value per share here? How do you calculate book value per share? What do you take? Equity divided by shares outstanding, because equity is your net asset value. Assets minus liability. So 55,600 divided by 4476,000 gives you 12.41. And then your price is a constant number, so I just drag them up for all the 4 multiples. So then I'm saying price divided by book value per share, 0.91. So this is price to book value. It is strange that the company is trading below the book value. Maybe the company has some problem or it is undervalued, either of it. Right, number 3, you want to calculate the cash flow per share. How do you calculate the cash flow per share here? What is your cash flow? Operating cash flow, we can use this. Free cash flow or operating cash flow, we'll use free cash flow, operating cash flow here, that's what is available. Divided by number of shares, 4476. So I get 3.999, that's my $4 is cash flow per share. So price to cash flow per share is 2.85. That's going to be your price to cash flow. The last one is going to be sales per share. How are you going to calculate the sales per share? You have the revenue, right? You have the revenue 77,300 000 divided by 4476. So that's going to be this. So sales per share, this divided by, to give you 0.66. Remember, I told you it will be lower because your sales per share is much higher than your EPS. So that's going to give you your price per cash flow. Now, I'm going to ask you one question. Don't look at the table above. Can you look at the table below? Right? Table below here, where we have calculated these ratios. Can you tell me what is the net profit margin of this company? Is it something that you can calculate? Is it something that you can calculate based on this data? I'm trying to understand your understanding here, how you are making a decision. So can you tell me, by looking at this table, can you calculate your net profit margin? How do you calculate the net profit margin? Based on the table below, which I constructed, not the table that we took it from the slides. How do you calculate the net profit margin, guys? So can you tell me what it is? How do you look at it? Your EPS, how much is going to be your sales per share, and how much is your EPS? EPS divided by, what is your net profit margin? That's exactly right. The last answer is right. EPS divided by sales. What is net profit margin, guys? Like, how do you calculate it? If I give you this table, what will you do? You take the net income divided by your net revenue, isn't it? Your net profit margin is your net income divided by your net revenue in your income statement. So what is the equivalent of net income in this table? What is the equivalent of net income in this table? Is EPS. What is the equivalent of revenue in this table? Is your sales per share. So if you divide 0.71 by 17.3, that is 0.71 divided by 17.3 gives you net profit margin. How much? 0.71 divided by 17.3 gives you 4%, so 4.1%. So that's your net profit margin. There is another way to calculate and justify. 3.2 million is your net income divided by your revenue, 17.3 million. Can you calculate and see if it gives you the same number? You see 3.2 million divided by 77,300 gives you again 4.1%, isn't it? You understand how it works? It's the same thing. So I mean, why I'm telling you this, because in the exam, you know, sometimes they might give you the company wide data, sometimes they might give you per share data. You know, I can even calculate, you know, I don't have to calculate book value per share, net revenue per share, net income per share. I can still arrive at the same multiple. See what I'm doing and make sure that you understand what I'm doing here. So see what's happening. What I'm going to do is I'm going to here substitute market capitalization. I'm going to put in here market capitalization. So what is market capitalization here, guys? How do you calculate market capitalization? Can you guys tell me? How do you calculate market capitalization? That's going to be number of shares times the market price per share. So this is the total value of the company. The share price is value per share. Value of the company is the stock price, or value of the equity is the share price times the number of shares. So that's going to be 11.4 in this case. It's going to be 11.4 times 4476000. And that's going to be a similar number. I'm going to put them all of them here. And here I'm going to put in net income. I'm going to here have equity. Here I'm going to have cash flow. Here I'm going to have sales. So this is going to be interesting. So what is your net income? Net income is 3.2 million. I'll just copy that and paste it over here. And your second one is your equity is 55.6, and your cash flow is 17.9, and your sales is 77.3. Have the 1000 separators here. So do you see your multiple are actually the same? Do you see that? Your multiples are the same in both price PE ratio, price to book, price to cash flow, price to cash flow, and then price to sales. Is that right, guys? Are we in the same page? Do you understand what I mean? We can do the whole thing based on the overall value of the company. So what I did in the second table, I calculated the market capitalization, which is the total value of equity. I'm dividing that by the net income, net book value, net cash flow, sales for the company. So that gives you the multiple. But if I want, I calculate per share data and divide price by that, I'm still going to get the same multiple. And this is normally what we do is in practice is this. All right, but also you need to know that you can also use these values. Now, I'm going to ask you more questions now. Now I'm going to give you, okay, industry multiples. Industry PE ratio is, let's say, 12 times. Remember, these multiples are always in times. This is 12 times. Price to book value is okay. Now you guys need to tell me, is this stock is overvalued or undervalued based on the PE? PE of the company is 15.95, but the industry PE is 12. Is the stock undervalued or overvalued? In the absence of any other information, what do you think? Is the stock overvalued or undervalued? Industry PE is 12 times and company PE is 15.95, 16 times. So you are industry average is that companies trade at a premium of 12 times above the EPS, but this company is trading 16 times above. You're paying 16 times the EPS. So which means it is overvalued. Okay, second one. What do you think about the second one? In terms of price to book, what do you think about it? Company is trading at a price to book of 0.92. If the book value is 1, the stock is trading at 0.92. But in the industry, the stock trades at 1.1 times above the book value. So what do you think about it? Based on price to book value, is the stock overvalued or undervalued? Based on that, it is undervalued. Okay. What about cash flow, price to cash flow? Industry is 2.5. Sales per share, industry is 0.6. So what do you think, guys? Is the stock overvalued or undervalued? Is the stock overvalued or undervalued? Based on both of them, it's overvalued because it's trading above the industry multiples. Then the next question is to ask you, what is the best valuation multiple for this industry? Maybe PE is the best valuation multiple for this industry. Then you go make your decision by PE. Then what do you think? Would you sell this stock or buy this stock? What would be your stock recommendation is going to be? What are you going to do? Are you going to buy this stock or are you going to sell this stock? You're going to sell this stock if you think PE is going to be the value. Now, I'm going to tell you something very interesting now. Then now you can ask me, okay, it's a decision-making tool, but how will you arrive at a value? See, what we are trying to do is, we are trying to say, this company is mispriced. It is not valued properly. But we assume the industry is correctly priced. So we assume the industry PE of 12 times is correct. So which means what should be the estimated price of this company? Based on the industry PE ratio of 12 times, can you tell me at what price this stock should be trading at? At what price the stock should be trading at based on the industry PE ratio? Industry PE ratio is 12 times. So how much the price of this company should be? But the company is trading at a 16 times of EPS, but we expect it to trade at 12 times of EPS. So if this company is trading at 12 times EPS, what should be the intrinsic value of this particular stock? Can someone estimate that? Are you guys there? How do you estimate that? Okay, how did you get that figure? You said, okay, you said it's going to be price. You're saying it's going to go up. How would it go up? Saying 16.9, the current price is 11.4. No, that's not right. You're expecting 11.4 divided by 15.95 times 12. Okay, you don't need to do any complex mathematics here. It's very easy. 0.95. And how did you get that 0.95? Again, you think the stock is going to trade at 0.95? 11.4 divided by 12. But you expect the stock price to drop from 11.4 to 0.95? Okay, simple. Think simple. The stock is EPS. What is this price? In PE multiple, how do you interpret? Your price is how many times your EPS is trading, right? So that is basically your 0.71 times 15 times 15.95 is your price. But you think it is 12 times, which means your price of the EPS is 0.71. So how many times above the EPS the stock can trade? It is trading at 16 times, but it can trade at 12 times. So meaning 0.71 times 12. That's exactly right. So the answer is 8.52. So the stock price is going to go down from 11.4 to 8.52. So I'm going to just show you that, how that is done. Basically, I'm going to multiply your EPS times this multiple. 12. So 12 times your EPS. Okay, now you're going to tell me the stock is undervalued on the basis of price to book. It's undervalued based on price to book. So what do you think should be the value of this company based on book value per share? Based on book value per share, what should be the value? How do you calculate? Is everybody else, are we on the same page? How do we calculate? 12.4 is the book value per share. So it should be trading at the industry multiple, because you assume the company is mispriced, but industry is properly priced, right? So that's what we are going to do. So we're going to multiply the book value per share 1.1 times 12.4. That's going to give you 13.66. So the stock price is going to go up because it is undervalued, because your multiple is lower than the industry. But look at this. So what about cash flow per share? How do you calculate it for the next one? Cash flow per share based on the price to cash flow multiple. What should be the stock price? 4 times 2.5. That's right. So cash flow per share times 2.5 is going to give you 9.99. 10. So it should drop from 11.4 to 10. And then based on the price to sales, sales is this times 0.6, stock price should be 10.36. So I'm trying to understand what is the percentage change. Estimated percentage change is basically the new price divided by old price. So you're expecting the stock price to come down by 24%. Here go up by 20%, come down by 12.39.1. We make based on the decision, we make the decision in this case maybe based on PE, because we think in this industry we mainly look at PE. But some analysts, what they do is they look at a weighted average approach, give 25% weightage for each of them and get an average of this value. Get an average of this value and say the stock price is 10.65. So it is 11.4. It is going to go down to 10.65. So it's a sell. And it is a sell because most of the valuation multiples pointing towards an overvaluation. That's why it is actually giving you a 10.65. So the average is 10.65, but the current price is 11.4. and this is the intrinsic value. So the stock should be a sell. Hope that makes sense. Okay, guys, coming back to this. Okay, the same thing we did. We calculated all this and then calculate the price to book value ratios like what we did. And then we decide undervalued, overvalued. In order to decide whether you want to know undervalued or overvalued, what you need to know? You need to know what is the industry multiples. But here they are not telling you how you will arrive at the value of a company based on a multiple, based on an industry multiple. So what you do, you multiply the EPS of the company times the multiple of the industry to get the price. So you think the industry multiples are correct, but your own multiples are actually wrong. So that's the end of price multiples discussion. And what is remaining for us is EV/EBITDA multiple. So we'll have more exciting discussion tomorrow. And so that's about it for today. And we will talk about the rest of the material tomorrow.